Hello traders, welcome back to our market analytics and trading program powered by Liteforex broker. I'm Roy Cuzin, and today I want to have a special one. Today we're going to take a bit of a break from our ongoing analytics and trading and finding opportunities and so forth. We're going to take a little bit of a different path. I'm going to take you straight to our educational trading session where I want to present one of my top favorite trading strategy. This strategy is different, it's unique, and the whole purpose of me building it was so I can further diversify my trading activities, right? And the best way I could think of, an efficient way to diversify my trading activities was to build a strategy that is solely based on the economical calendar, right? The economical news events. So it's very different, it's very unique. I think you're gonna love it. I've done a lot of research, but I've done about a year of research during 2014 up until late 2015, and I gathered a lot of information. And then, of course, after doing a lot of research, I began to build up that strategy around the numbers, around the data that I happened to found after about a year of just examining the market and in different points. So it's going to be super interesting. Let's go ahead and dive in. So when I was researching for this strategy, I was looking at many news events. Actually, I was looking at 8 different news events, and after 1 year of gathering data, I came to a very clear conclusion that there are mainly 2 news events, right, that are the most impactful on the market, right? As they're being released, I've noticed that these 2 news events are hugely influencing the market, right? I mean, not every single time, but obviously a lot more than the rest of the news events that I was researching. So these are those 2, right? We got interest rates, and we have the non-farm payrolls, mainly, talking about the US non-farm payrolls, right? So all of our focus, all of our attention is going to be around these 2 news events. And let's take a look quickly on the definition of those news events. We'll start with the interest rate, right? So the interest rate, we can find interest rate in every single country. Now I'm talking about the G8 countries, like the major countries, right? The countries that that consist of the majors, right? We're talking about 8 countries, the G8, where you combine those countries with the US dollar, you get 7 major currencies, right? So you can think about it this way. We can use this strategy, right, on interest rate coming from every single one of those countries. So for example, if we have an interest rate coming from Canada, I would go ahead and take action on the dollar versus the Canadian, right? And on that scale, if we're having an interest rate coming from Switzerland, then I will engage with the dollar versus the Swiss franc, right? Now, in terms of definition, when the central bank increase the interest rate, right? I'm going to cut straight to the bottom line here. You can obviously read out the official definition, but basically, when the central bank increase interest rate, that supports the currency, right? That supports the relevant currency, the respective currency. So it has a positive effect when you increase interest rate, and vice versa, negative effect when the central bank decrease interest rate. Now, in terms of non-farm payrolls, that's probably the most impactful, right? Probably, because it's always, with interest rate, it does have a lot of effect on the market only if price deviates from the expectation, and usually it doesn't, right? Usually it's right on top of the expectation. So, here it's a bit different, because this one is always never, right, in line with the expectation. It always deviates from the expectation, so it tends to be even more impactful, right? The non-farm payrolls, that's probably the number one news event you would like to use when approaching this trade. So when this one turns out negatively, right, basically, underscore the expectations, it tends to have a negative effect over the respective currency and vice versa, right? So when the trend on non-farm payrolls is on the rise, that usually supports the respective currency. So we have these two major news events, right? Now let me show you, let me talk to you about the potential instruments and frequency of those news events. So in terms of interest rate, like I said at the beginning, right, every single one of the countries that we were working with, which is part of the majors group of currencies, you will have once a month a decision on interest rate. So think about it, we have 7 different currency pairs in the majors group. So you will have 7 different interest rate decisions in a single month, right? That puts the average around 1.5, up close to 2 decisions in a week, right? So we got that's the frequency in terms of interest rate. And we're going to be using all major currencies, like I said before, depending on the specific country that releases this news event, right? With regards to non-farm payrolls, here it's not as frequent because we have it only once a month. It's always only coming from, only addressing the U.S. non-farm payrolls, right? So basically this takes place every first Friday of every month, and here we'll be engaging with either the pound dollar or the euro dollar, right? I usually choose between either the euro dollar or the pound dollar, and sometimes I'll use both, right? But this is pretty much the participating currencies on the non-farm payrolls. Now, let's have a look at the basic principles of engagement, right? So now we're going to begin to get to know the actual, principles of the strategy and how to implement it. But first, I'm going to talk to you about, the general concept. When it comes to the basic principles, we're going to take action about 30 minutes before the release of the news event, right? And what we're going to do is we're going to place 2 opposite trades, same trades, the very same size, right? Opposite to one another on the same currency. Now, so for example, we had interest rate coming from Canada. I would place a buy trade on the dollar versus the Canadian and a sell trade, right? 2 opposite trades. And for both trades, I'll place 100 pip stop loss, right? Stop loss 100 pip from entry to both sides, right? So either each one of the trades will have a stop loss level of 100 pip. And with regards to the take profit order, both of them will have a 30 pip distance to price target, right? So both of them will have 100 pip stop loss level and 30 pip take profit order. Now, I want to present to you the statistics. This is average statistic that I have been gathering during 2014 and 2015, and these are the numbers that I came up with, and those were pretty consistent throughout the years that I've been using this strategy up until pretty much these days. So here are the numbers, and this is why I've built this strategy around these 2 news events, because I was having this data, this statistics, and I could build up something that actually makes sense and actually work. Now, I went on the safe side when it comes to the numbers, and I'm going to explain to you exactly what I mean. For example, Out of all of the news releases that I've been researching, right, I'm talking about all of the interest rates and non-farm payrolls within that year that I was, examining. I found out that about 20% of the news events, price actually remains stable, right? When I mean remains stable, I mean it doesn't really move much. I mean, it could move a few pip up, a few pip it's going to go down again, but it's never going to reach neither one of our orders, or automatic orders, neither one of the take profit orders, which are much closer than the stop loss, right? So it doesn't reach 30 pip to each side. It just stays put pretty much, right? That's about 20%. Now, when we place two trades and nothing happens, right? It remains in the same place pretty much. And after the news, right? After the news event is released, still we have no movement for about 5 minutes. That's pretty much what I call it. Where I call it out, right? I call it out and I close both trades. Simple as that, right? If I don't have the move that I want to have, I'm closing both of them. What I did here was to assign 2.5 pip, roughly, for every currency, right? For every pair. For every time we open and close a trade, we lose the spread, right? We all know that. So in this case, I assigned 2.5 pip for every trade. So whenever price remains stable, I'm basically closing both legs and I'm losing 5 pip, right? Since we get that 20% of the time, then I would have to lose 10 pip. Out of 10 positions, I would lose, out of 10 attempts to trade, right, the strategy, I would lose 10 pip, right? Now, 40% of news events, right, of these news events, price will consistently move in one direction. For 40% of the time, price will go straight to one of the two directions. Now, that would cause, right, the take profit order to be exercised on one leg, right, and the stop loss order to be exercised on the other leg. So basically what will happen is we'll be ending up losing 100 pip on one leg and winning 30 pip on the other leg. Net loss would be 70 pip, right? And that happens 40% of the time. All right. Now, the third scenario here is where price is volatile and spiky. And that's exactly what I was aiming for when I built that strategy, right? Because I knew, basically out of experience, just watching the market for many years, reacting to these news events, I knew that in most cases, it's very volatile. Before the news actually being released, it's very volatile, it's spiky, it goes both ways, right? It's hectic. And to be honest, I thought that it was even more than 60% of the time, but then when I've done the research, I found out that it was less than what I was expecting, but still high enough to have something to work with, right? So here are the numbers that I found back in 2014, 2015. I found that 60% of these news events, price is volatile and spiky enough to take both legs out with profit, right? So price will go one way, take 30 pip profit, and then go the other way and take the other 30 pip profit without touching the 100 pip stop loss, right? So in 60% of time, we will end up winning both legs, right? Six out of every 10 positions will, on average, will end up making 60 pip, right? 30 pip on one side, 30 pip on the other. Pretty simple, right? Now let's take this to the matrix, right, to the profitability matrix, so to speak, and see how that adds up, right? And this is pretty much where I conclude the strategy. It's pretty simple, but it's smart, and it's actually quite unique in its approach. Now, the fact that we're screening the very most, the most impactful news events, that's what's pretty much, creating this, this potential profit matrix, if you will. So when it comes to profitability, right? When it comes to probability, we said stable 20%, runaway, straight one direction 40%, and spiky 60%. Now, per trade, right? We're losing 5 pip with the stable scenario. We're losing 70 pip, right, on the runaway scenario for one trade, right? I'm talking about one engagement. And we're winning 60 pip with the spiky scenario. However, if it's 20% on minus 5 pip, then we're going to be losing in total 10 pip, right? And with the runaway scenario, since it happens 40% of the time, so we can multiply 70 pip by 4 and we'll end up losing 280 pip, right? So we're already in a loss of 290 pip, guys. Nevertheless, the spiky scenario that occurs about 60% of the time and end up giving us 60% per engagement will be total of 360 pip, right, by the end of these 10 news releases events. So when you make the bottom line here, you figure out that after engaging with all news events throughout that year, you'll be ending up making about 70 pip, right? For every 10 engagements, you'll be ending up with 70 pip. Now that may not sound a lot, but obviously you can always use higher leverage to take advantage over this simple profit matrix that I have found after doing a lot of research on this market behavior. So that's pretty much it, guys. Simple strategy. It doesn't take much to implement it. You just need to be on top of the economical calendar, right? You need to know exactly on what time, from which country you have an interest rate decision, and above all, of course, you have to be on top of the non-farm payrolls. I found out that the non-farm payrolls was far more profitable for me than the interest rate decisions. The stableness in the interest rate decisions is greater than in the non-farm payroll. So what you see here, 20%, is actually an average of all news events. But if you divide it, if you have to pick one, I would go only on the non-farm payrolls. If you have more time to engage with this type of activity, then obviously the interest rate decision is also pretty important. Alright guys, that's about that for today. I hope you enjoyed the session. Till next time, be well.